While we were tackling some of the more complicated issues in finance, we thought it appropriate to also tackle some of the more basic issues in finance. And computations in finance that are performed all over the place and are very prevalent are time value of money computations. These computations are taught in the curriculum for financial programs, accounting programs. They're used in actuarial work, in the world of corporate finance, investment banking, etc. So we built a function here called time value, which calculates future and present values of lump sums of money or securities as well. The syntax is as follows here. You have the time value of function. The first argument is, in this usage, is the amount. The second argument is an effective interest rate you wish to use. And then the third argument would be the time at which you wish to value it. If that argument is positive, you're indicating you want to grow money. If it's negative, you want to discount it. And you can see it takes symbolic parameters here. So what you end up with is a Mathematica expression. If you want to take into account the effects of compound interest, you can use the effective interest function. And the effective interest function takes an interest rate and a compounding interval, which I call here 1 over f, f being a compounding frequency, as some people are used to seeing it. And so time value values this in the same way, but now using a different type of compound interest, user specified. There's all sorts of computations that can be performed, time value type of computations, not just finding present value and future values, but often you want to know the internals, like a particular interest rate that it takes to get from present value to future value, or the number of periods. And so rather than invent a new function that solves for each of these variables, we decided to use the existing Mathematica framework, which is great at solving all sorts of problems. So solve here will do exactly that. Here we solve for the parameter S, which would be the time that you would grow money in order to turn an amount PV into FV, future value. And you can see it's symbolic. Another type of security that time value takes to value is a stream of cash flows. So the symbol cash flow will take a list of cash flows that occur at regular time intervals. Here we have CF0 occurring at 0, CF1 at time 1, 2, 3, etc. And we're going to value the stream of cash flows in an interest rate R at time 0, meaning we want the present value of this. So we run that and we get an expression representing the present value of this cash flow stream. Another usage of the function cash flow is to manually specify the times at which the cash flows occur. So here we've got a different usage where we specify cash flows and times. So we have T1, at time T1, cash flow 1 occurs. At time T2, cash flow 2 occurs, etc. And we're going to grow it at interest rate R, grow or discount. We don't know yet because the valuation point S is symbolic, is a variable. And so time value values that. And using the solve function again, and there are several functions that solve things in Mathematica. Oftentimes when you're solving for interest rates, find root, if you're using numerical parameters, is much faster and better than solve. So here we can ask a slightly more complicated type of time value question. At what time T3 will a third cash flow, CF3, have to occur to cause this stream to accumulate to, say, 5,000 by time S? And so we use the same time value expression above there, and we set it equal to 5,000 because that's what we want it to grow to. And we solve for the time T3. And as you can see, it spits out a symbolic expression for that. Time value also takes an annuity as an argument. So an annuity represents a series of payments that occur in regular intervals, and typically the payment is either constant or it's got some pattern to how it grows or decays. Here what we do is we specify that we want the present value. The time argument is 0, and we're going to discount it at rate R, and we specify an annuity with payment PMT over n periods or n payments, and the third argument to annuity there is the payment frequency. So you can change the payment frequency. And one thing to note here is that we've got a closed form expression for annuity. A lot of times what you see as solutions to present value problems involving annuities and cash flows are solutions in finite series terms. You see each cash flow together with its discount factor. And that's just fine until you start getting into a large number of terms. A 30-year semi-annual bond will give you, or let's say annuity, will give you 60 terms. And that's kind of cumbersome to carry around with you or to plug into a spreadsheet formula. So here we default to closed form solutions. And here's just an example of a situation where we use annuity with a quarterly payment frequency, but the interest is compounded semi-annually. So this is a common problem where interest compounding is different from payment frequency. But TimeValue doesn't have any problem with that. Okay, and annuity also takes as its first argument, instead of just a symbolic or a constant payment, you can specify a payment function as a pure function. And what this does is say that payment is going to change over time, and it's a function of time here. Oftentimes, annuities are specified as in the payment will grow as a percentage of the previous payment. And as a result, you don't really have a function of time. You have a function of the previous payment. So if it's payment's growing by 3%, it's 3% of the larger than the previous payment. But Mathematica has RSolve here, and RSolve will solve recurrence relations like that and give you the same thing as a function of time instead. So RSolve is very handy to use for payment functions in annuity. Any user-defined function can be used in annuity or Mathematica function as well. This function, FinancialBond, the syntax of it is very similar to financial derivative. It takes a list of parameters. The first list is parameters that are intrinsic to the bond itself, and the second list are parameters that are associated with the market or the sale of the bond or valuation techniques. So all the intrinsic parameters here are specified. A bond has a face value, a coupon rate, maturity date, and coupon intervals. And here we say that the market interest rate we're going to value the bond at is 5%. We give it a settlement date, and then you can give it one of over 10 day count basis options in order to use different day count conventions to value the bond. FinancialBond can do several things and give you several different properties associated with it. If you use the property rules here, what you get back is all the different properties that it can compute for this particularly specified bond. Here we've got two different types of values. We've got the accrued interest, duration, modified duration, convexity, measures of risk, and then various coupon or various calendar measurements as well. FinancialBond also takes symbolic parameters. So you can input par, for example, as the face value. You can specify a coupon function rather than just a coupon rate or a constant coupon. And what this is very similar to the way TimeValue annuity works. And in this way, you can specify a coupon that grows over time if you're trying to simulate maybe an inflation-protected bond. You also get back closed-form solutions for FinancialBond too by default. And as you can see by the presence of the 365 here into the denominator, one of the day count conventions, actual over 365, is visible here. There's a variety of interest structures that you can plug into TimeValue and to FinancialBond as well as the interest rate specification. In this case, you see we're valuing an annuity, finding the present value at time 0, and we're using a schedule of rates. This schedule would be a schedule of short-term rates representing our expected future spot rates. And as you can see, TimeValue will value it based on this rate schedule. FinancialBond does the same thing, and both TimeValue and FinancialBond can also take, in addition to a rate schedule, it can take a term structure of interest rates. So you could look up today's yield curve in the Wall Street Journal and plug it in with this set of rules here. You can enter in something also called a force of interest, which you might call a discount process as well. And that would be given by this exponential function. I don't know if it's large enough to see, but this is the rough structure of it. In this case, the force of interest that you hand TimeValue, it's a continuous function of time. And it represents this delta of u here. Now you may be able to get more complicated with stochastic processes by viewing some of these parameters as random variables. And that would be up to the user to see how he wants to integrate that with the statistics framework. Here we have effective interest. If you don't have a compounding argument and you give effective interest a term structure, it will bootstrap the expected spot rates from it. By setting the coupon interval or payment interval to 0, the annuity's first argument as a function will become a continuous function. It will become a payment flow rate, rather. And FinancialBond can do the same thing. And here I've got an example where FinancialBond coupon interval is 0, the coupon is a payment flow rate, and the interest is a force of interest, and they work together. The last example here is one that was sent to us by the user Seth Chandler, who's also a speaker here. And it was used in one of the other presentations too on statistics, I believe. But here we show that the symbolic nature of time value and FinancialBond can be integrated with the statistics framework. Basically, in this case, what we have here is an insurance company is, say, insuring someone for life insurance. Unfortunately, we don't know when the death will occur. We use a variable t for that. And then we take its expectation using the Gompertz-Makeham distribution, which is for mortality. We do the same thing with an annuity, because what the idea here is to set the present value of this future obligation equal to the present value of an annuity of premiums we're going to charge the insured. And because, once again, we don't know how long the annuity will last, since we don't know how long this person will live, t is a random variable. We use the expectation using the same distribution, set the two equal, solve for the premium. And that's it. Thank you very much.